Hi, my name is Stephen Nolan and I'm the Managing Director of the UN-convened Financial Centres for Sustainability. I'm also very proud to chair this week's Climate Finance Week, Ireland's fourth Climate Finance Week. It's been a week incredibly busy, 38 events, 100 different speakers and a lot of action across the week, not least presenting to Mayor Bloomberg this year's Climate Action Leadership Award. We're in the final day and I'm really excited about this agenda, which is focused on key developments in sustainable finance debt markets. It's been organised in association with S&P Global Ratings and Lucina and Anna Maria are going to drive forward this agenda for us today. So if I can hand over to Lucina to get us going, and thank you very much for supporting Climate Finance Week.
Good morning. Thank you, Stephen, very much for that introduction, to Catherine and the whole Climate Finance Week organizing the event for the organization. So my colleague Anna Maria and myself will cover in the next session really an update on the sustainable finance debt market, and we'll also talk about the sustainable financing opinions here at S&P Global and a key case study that we'd like to share with you today. So if we can just kick off, and I'll provide a very brief overview to start really with about the sustainable debt market itself, which is comprised of two main categories of different instruments. The first one is use of proceeds instruments. As you can see here on the screen, these are ones where the proceeds are used to finance specific projects with environmental and or social benefits. Green, social, and sustainability bonds fall under this category of instruments, whilst in the second category, we have the sustainability-linked instruments, which are different from those described before, the use of proceeds, in that the proceeds aren't directly focused towards specific projects. Instead, the proceeds are used for general corporate purposes, and the repayment terms of these instruments, such as the coupon rate or the interest rates, are pegged to the issuer achieving sustainability-related KPIs in most of the cases. In other words, as well, if the issuer fails to meet their set goals or targets, the coupon rate or the interest rate of this instrument may increase, whilst if they meet these goals or targets defined in that specific instrument, the coupon or the interest rate may decrease. So those are the different instruments currently at the moment being the most popular ones that we refer to through the sustainable debt market. Just passing over to the next slide. Okay, so I think it's worth saying that investor interest in sustainable finance has grown rapidly over the last few years. You can see here on the graph on the right, the forecasts that are predicting that it will continue to grow really sharply over the next decade or so. If we quote BlackRock, they believe that the investors will double their allocations to sustainable products over the next 5 years. The growth is really global in nature, and we're starting to see interest accelerating, particularly in developing markets, where historically those have been pretty absent from the sustainable finance space. So this is really a global effort and a global trend that we're seeing going forward, and it's very promising as well. When we talk about specific forecasts and numbers, the issuance of the sustainable debt, as I've been saying previously, is rising exponentially. It was around $200 billion in 2018. And by the end of last year, the market tripled. So that was 3 times 2018, ending above $600 billion of total issuance. And really considering the market developments of what has been the half of this year, we think that the end of this year could really exceed up to $1 trillion by the end of 2021. You can also see here in terms of market composition, the green bonds, which is the light blue, are the most mature segment of the market and have really historically developed and really dominated the total sustainable debt issuance. However, over the last few years as well, the type of issuance has become increasingly diversified. So we see a prominence or a bit of a growth, let's say, as well when it comes to social sustainability, but also sustainability-linked bonds, comprising really a much larger share of the markets. We think that 2021 will also reflect this growing trend as we progress. Now, I'm going to spend a couple of minutes really talking about the use of proceeds instruments per se and what we see as the next trends in the markets. When it comes to use of proceeds instrument, Europe continues to lead the way. First of all, is we refer to the green bond issuance, as you can see in the graph on the top left. I hope you can see it. The slides will be circulated. Largely because of the political push at the government level to be carbon neutral by 2050, a target that the European Union set far before other countries, and also a push in favor of using sustainable finance to help get there. For example, you might be aware that the EU recently announced that 30% of the COVID recovery plan will target climate-friendly projects, a lot of which could end up in the form of green bonds specifically. However, we could also say that the growth in the green bond market is not only coming from the EU. The US-based issuers have actually been leaders in the green bond market over the past few years. You can see that on the right chart as well on this slide, ahead of any other country. And we can expect as well that the US will maintain its dominant position in the market, especially given the very ambitious set of environmental priorities that are being set by the current administration. We are also likely to see an uptick in green bond issuance in the APAC region, such as Japan and China, also aim for carbon neutrality by 2050 and 2060 respectively. And just to finalize on this slide as well, the Climate Bonds Initiative, the non-profit organization, which is specifically focused on developing the green bond market, is predicting that 14 sovereigns could issue green bonds for the first time over the next 2 years, which could really be key in driving the green bond market growth going forward. So that's really interesting in terms of diversification of the issuers globally as well. If we move on to the next slide, in terms of the green bond issuance and the different technologies or projects types that are being financed currently, we can see that renewable energy, as expected, green buildings and green transportation have really dominated the space. This is likely because these technologies are more direct and immediate in terms of their impact and also their revenue stream for investors, compared to somewhat less mature technologies in sectors such as agriculture or forestry as well, or even water, which investors may not be as familiar with at the moment. But nonetheless, as the total green bond issuance grows, so will the absolute contribution of these various different type technologies. At least that's our view going forward. But it's very relevant to see that between renewable energy, green building, we have, those are the most dominant currently, as probably as expected for the green bond market itself. In terms of the private sector, you can see here what has been on this slide, the progression in the past 10 years in terms of the diversification of the issuer type. Back in 2010, we see a dominant position of development banks in terms of issuance, whilst now, at least up to 2020, really the non-financial corporates, development bank here has decreased to 19%. We see, a huge uptick of issuance from non-financial corporates or even financial corporates, and even prominence of financials and local governments or sovereigns. So really the picture is changing rapidly, and it's, there's a lot of diversification from what was a pretty dominant position back in 2010 by the development banks when it comes to the green bond issuances. I wanted to spend some time also covering let's say, the latest developments on the social bond market as well. You can see here in the charts, what has been an explosive move, let's say, by 2020. Social bonds itself have been historically low, comprised by a very small part of the sustainable debt market overall. they were making up only around 20 million US dollars, or even only 5% of the total market in 2019. But over the last year, the market grew by almost 800%. This spike is really driven by as you can expect, the response to the pandemic, which really heightened both issuers and also investors' attention to these matters, and as well social justice issues such as income, gender inequality, rising unemployment, and access to different essential services like somewhat, for example, education or healthcare. The public sector really stepped in quickly to fund projects which help address some of these social issues back in 2020. And you can also see on the bottom right graph that development banks and government agencies really dominated the social bond space in 2020 for these particular reasons. So there's been really 8 times increase or growth in 2020 for the social bond market. And if we also have here the breakdown of the different projects that have been financed for the social bonds in 2020. They are much more diverse than those for green bonds. You might be able to notice that. You can see here that social economic advancement and empowerment, housing, and healthcare are the largest categories by terms of issuance volume, but other categories as well, such as education or essential services, essential infrastructure, are also very prominent. In terms of healthcare, it was obviously a key theme in 2020, with many issuers using social bonds to help finance healthcare infrastructure projects or vaccine distribution or other recovery measures related to the pandemic. But the picture on the social space is much more diverse of what it is on the green space, at least until now. If we move on now to the sustainability-linked instruments, I'll just spend a couple of minutes, first of all, providing a bit of context on what they are and what we see that the role that the sustainability-linked instruments will play in the market going forward. These instruments are expected to really broaden the universe of issuers who can obtain sustainable financing to those that may not have sufficient capital expenditures connected to sustainability projects, or for example, those that are at the beginning of their sustainability journeys or are in the transition and hard to abate sectors. We also expect banks to play a role and to spur growth, given their need to fulfill corporate objectives relating to the share of the impact financing within their lending books. So banks also have a role to play in terms of the sustainability-linked instruments in the near future. In terms of companies, we expect them to use the sustainability-linked instruments to fund, for example, innovative environmental technologies and really a broader range of social and governance KPIs, which are also expected to be used and defined through these instruments going forward. The concept itself of sustainability-linked instruments is really likely to expand beyond the classic sustainability-linked loan or bond structures into other instrument types as well, from our perspective, including the newly developed sustainability-linked green bond, for example, that is combining use of proceeds and sustainability-linked bond models all together. So really something that is evolving over time, and very interesting to see the different features within these instruments. So in terms of the sustainability performance targets, let's say, in practice, the targets can include really a number of factors, but are usually specific environmental, social, and or governance KPIs that are tracking improvements in a borrower's or issuer's sustainability profile. In some cases, a sustainability performance target could also be an overall, let's say, ESG score assigned to the borrower or to the issuer from an external provider. The target approach is being adopted currently in the market, and it's varying largely depending on the instrument type. For example, most sustainability-linked loans are linked to more than one sustainability performance target or KPI, sometimes up to 4 or 5, or even, as I said before, to an overall ESG score or rating that is capturing these different ESG indicators. Whilst on the other hand, in terms of sustainability-linked bonds, KPIs are usually simpler in scope, with one KPI being the most common structure currently. So there is as well differing features, let's say, between the different loans or bonds in these specific markets. The distinction really is, from our perspective, largely attributable, let's say, to the different market structures. The loans are usually syndicated by, at least currently, by a small group of banks that have very much deep in-house knowledge or expertise and sophistication. And the increased level as well of interaction with these lenders makes it, let's say, easier to track more complex targets on a frequent basis, for example, on an annual basis. Whilst on the other hand, the investor pool for the sustainability-linked bonds is often larger and highly diversified. So this really increases the demand for a mechanism that is somewhat simpler and easier to track, with those targets usually being concentrated on a specific environmental or social factor, as those that you can see in the chart at the moment. For example, the ECB is currently only accepting bonds under its asset purchase program that are linked to targets with environmental objectives, such as those related to climate change or environmental degradation, and doesn't currently consider improvements in ESG ratings or scores as acceptable targets for these instruments. Whilst the bond market is still developing, we believe that the KPIs at the moment are currently expected to remain, let's say, limited in scope and highly concentrated on environmental factors, at least for the next few years when it comes to linking those specific KPIs or sustainability performance targets. And just to finalize from my side, the last slide is really talking about the pricing mechanisms. Is fairly detailed, let's say, and it's really based on the fact that, according to ICMA, the financial or let's say the structural characteristics of a sustainability-linked instrument are going to vary depending on whether the predefined target or KPI is achieved or not. So basically, these pricing adjusting mechanisms that I've been referring before, they tend to operate in three primary ways. There's a benefit mechanism, so that will be one way. There's a penalty mechanism, the other way, let's say, or the two-way, which is a benefit and a penalty mechanism, both of them together. Let's say, so with, for example, with a one-way benefit mechanism, an issuer is facing a margin discount if it meets its predetermined targets, but will face no penalty if it fails to do so. The alternative is true with a one-way penalty mechanism. On the other hand, with a two-way mechanism, the issuer will obtain a margin discount if it meets the targets, or it will face a premium if it fails to do so. So those mechanisms are the three primary ways at the moment to adjust, let's say, the pricing instrument. Because really the primary objective of the sustainability-linked instruments is to provide those incentives to the entities to improve their performance. Many instruments, specifically in the loan market, have historically adopted a two-way mechanism with an equal and opposite benefit or penalty if the company meets or fails to meet its performance targets. While the financial incentive isn't usually disclosed, we understand it's often relatively small, typically in the range of between, as you can see here, 5 to 10% of the initial margin, capped at 15 basis points. Whilst in the bond market, there's the picture is slightly different. Most instruments have a one-way penalty mechanism, with the most common one being a one-time 25 step-ups or 25 basis point step-ups if the targets aren't achieved in a specific time frame. And so far, finally, the only cases where the bonds have had a two-way mechanisms are at the moment what we've seen in the private placement market. For example, the French elderly care and support group Corian and the French utility as well, Albioma, were really the first entities to issue sustainability linked euro dominated private placements, which are applying into the two-way pricing mechanisms. So there are some cases out there that we can refer to in terms of those pricing mechanisms, even in the private placement space. So I hope this has provided some interesting overviews, and I will now pass it on to my colleague Ana Maria. She will cover the sustainability financing opinions that we offer here at S&P Global Ratings. Thank you, Ana Maria. I pass it over to you.
Thank you, Luisina. So yes, I will talk about where is currently S&P Global Rating on these products. So just a second. Okay, so following ICMA definition, ICMA defines four broad categories of external review. S&P Global Rating is currently present in the first two categories. In the first one, as a second party opinion, we provide an assessment of the alignment of a framework or a transaction with the specific principles. And the second one is required more a score or rating of a bond or transaction. Here we're present with the green transaction evaluation, where we assign actually a numeric value for environmental benefit. We are not present in the other two categories, which is an external verification or certification. Here, a bit of an overview of our sustainable finance product suite. So for one side, we have the ESG evaluation, which here we are just basically assessing the ESG performance of a company. And then on your right, you have the sustainable financing opinions. Currently, we changed the name to sustainable financing opinions in order to align better with the language of the market. Here we have on one side the transaction evaluation, which is the one that we just mentioned, that provides a numeric benefit, environmental benefit of a transaction. And then on the right-hand side, you can see the offer on second party opinions, provide dedicated use of proceeds, green, social, or sustainable. And starting from August, we are now also able to provide SPOs on transaction or framework that are related to sustainability linked principles. Maybe if we can pass to the next one. Here, what we are also seeing is that the standards and frameworks in the market are continued to develop. We have from the International Capital Market Association and the Loan Market Association that came out first with the Green Bond Principles. And recently, this year, you have several updates on all the principles and from the side of the loans, also an update on the sustainability linked loan principles. Besides that, we have developments at a local level. An example is the European EU taxonomy as a classification of green investments. But as well in other geographies, you can encounter different variety of green and or social classifications. We expect that these developments will support the development of the sustainable debt market and support as well. We will be there as well to support this development. So now taking a bit of a deep dive in our sustainable second party opinions. First, what are they? They are standalone opinions of a transaction or a framework that aligns to a specific set of principles. For the second party opinions, we do not quantify individual environmental or social benefits. We provide an overall aligned or not aligned opinion of the documentation against the key components of the applicable principles. And now, starting August, we can also provide for some of those components a bit more of information saying if we see that they are aligning just with the minimum requirements of the principles or they are integrating some recommendations and best market practices, and provide that in a scoring that goes from not aligned to advanced. We're going to talk a bit more about that in the following slides. On the right, you can see the principles that are currently on scope. So from there, you have the dedicated financing principles from ICMA, LMAID, and the Asian Capital Market Forum. And as we just mentioned, recently also principles, we also offer opinions on principles that are sustainability-linked bond principles and sustainability-linked loan principles. So in the following slides, what we're going to do is go over the key analytical factors that we look at for the different types of SPOs. So to start with the sustainability-linked SPOs, we follow the 5 key components of the principles. In the selection of KPIs, we're going to look at individual level for each KPI. How well is the KPI defined? If the methodology, for example, is public, if the scope is clearly outlined. And as well, we're going to look how relevant this KPI is to the industry and how material it is for the issuer's sustainability strategy. For the calibration of the targets, once again, we're going to look at the characteristics of the target itself, how well it is defined, and we're going to assess the ambition by comparing it to its own performance, historical performance, or external benchmarkings, which can include peer performance or industry trajectories. Moving on to the instrument characteristics, here, can you come back one? So can you return one, please? One slide. So for the instrument characteristics, we are going to look at basically what are the rules of the instrument or the framework in terms of what Lucina was explaining. What is the mechanism if there is a malus or bonus, and if there is a fallback mechanism in case the performance, for example, cannot be calculated. Then for external review, we're going to look at the commitment to have an external verification of the performance against the target. And finally, for reporting, we're going to look at what are the disclosure commitments that are taken by the issuer and documented in the framework or transaction documentation. I think we jumped one slide. Lucina, if you can go back one to the 23. This one is just quickly to look at the overview of what we look at the use of proceeds. So here, once again, we follow the 4 components of the principles we have for the use of proceeds. We're going to look at what are the commitments for using the eligible funds for projects that have an environmental or social benefit. For process for project evaluation and selection, here we're basically going to look at how is the issuer internally organized to select and monitor those eligible projects. And management of proceeds will be what are the tracking methods that they're going to utilize during the term of the instrument. And finally, for reporting, once again, here we're going to look at what are the disclosure practices and commitments that the issuer is taking in terms of transparency. So now I think we can move to the next one. Here is just to kind of give an overview of the scale scores that we were talking about before. So in the first row, you can see which are those components that we will be able to provide a score signaling when the documentation or commitments go beyond the minimum required. Here are our 4 levels. So when it's not aligned, that means the component is not meeting the minimum required by the principles. Then you have satisfactory. That means that the issuer is meeting at least the minimum required by the principles. And then by incorporating other recommendations and market practices, the score can improve to strong or advanced. So now we can show you a case study. Here, that's basically how our SPO looks like. You're going to find in the first page a summary of the issuer, the sustainability strategy, and in the case of sustainability linked, you're going to find also a summary of the KPIs with the applicable targets. And on the second page, you're going to find a summary of the key components that we are assessing. In this case, because it's a sustainability linked, you can also see the scoring for the KPIs, the targets, and reporting. Now I'm going to spend a bit of time discussing mainly the first 2 components, which is probably the ones that are quite different from the other instruments. In this case, for example, with the KPIs, this issuer decided to use 2 social KPIs, which for our view, that was a highly material ESG issue for their industry and for their strategy. In this case, also their sustainability strategy was embedded in the corporate strategy, and it was related to business transformation. And thus, for the as well, they decided to use within their one of the 2 KPIs a financial proxy, which in this case we understand why they chose it. It is directly linked to a business transformation. It allows for comparability, yet the link between the social benefit and the result of the KPI was not completely direct. So that was a limitation in this case for that KPI. Another limitation that we saw at this stage, still aligned with the principles, but that limit from S&P side our assessment is that this industry is a very small industry. So at the moment of looking to the ambition of the targets, there was not enough information to compare these targets to peers. So according to historical performance and internal trajectory, we believe these targets were ambitious, but we didn't have enough information to compare these with peers or industry trajectories or standards. So that's why we decided that yes, this was aligned with the principles, but we were not able to provide a higher score. Besides these 2 sections, our SPOs also have a section where you're going to see the detail of the rationale for each of the scoring that we provide. And at the end, we have a voluntary section. It will not impact the score that is related to the SDGs. So for use of proceeds, it will be a mapping of the eligible categories against the ICMA SDG mapping. And for the sustainability linked SPOs, this will be a mapping of the KPIs against the SDGs. And that's it from this side as well. So back to you, Lucina.
Thank you, Ana Maria. I think that's really all from our side. I haven't seen any questions up, so we'd like to thank you again for your attention. We hope this session has been interesting to you. We want to thank again the organizers of Climate Finance Week here in Ireland. And thank you for your attention, and goodbye.